I'm Meg Green with AM Best TV. AM Best is maintaining its stable outlook on Canada's property casualty and life insurance sectors. There's some variation in the reasons behind each sector's outlook. Joining us to discuss each of these sectors are Senior Financial Analyst Gordon McLean and Ed Kohlberg, an Associate Director in the Life Ratings Division. They'll be traveling to Toronto to participate in AM Best's Canada Marketing Briefing on September 5th. The focus of the event will be AM Best's annual deep dive into Canada's insurance sector. Gordon, let's start with the property casualty side. How would you characterize the overall performance of Canada's property casualty writers over the past year?
The performance has been stable over a long time. As you mentioned, we have maintained the stable outlook, and that reflects the consistent balance sheet strength of the industry presently, but over a period of time. From an operating performance standpoint, the results have been remarkably stable within a narrow range. The stable outlook also reflects ongoing initiatives to improve underwriting platforms, as well as the improvement in some of the ERM programs and integration of some InsurTech initiatives.
So as we move to the last quarter of 2018, what challenges might be looming on the horizon for Canada's PC industry?
You know, it was a bit challenging in that we've had an increase in natural catastrophe losses from a number of events. We had 15 cat events versus 13 last year. Now in 16 we had the Fort McMurray loss, which was close to $4 billion. We didn't have a significant event like that in 17, but we had an accumulation of events. Where it impacted results a little bit is that a number of these events were not significant enough to reach the attachment layers of the insurers' reinsurance programs, which meant that a lot of the carriers retained these losses net. However, having said that, results improved relative to 16, although not as much as you would have expected absent another Fort McMurray cat loss. Going forward, things that we're looking at, Ontario Auto is always a challenge. There has been an increased frequency of severe losses there. That's nothing new, it's just something that the industry is continuing to work through. Weather's always a wild card, so we continue to watch that. And one of the other things that we're looking at is just the as we discuss in the paper, the integration of some of the InsurTech initiatives that companies are really grasping and embedding into their platforms. And really, the question really is as you start to innovate and integrate these platforms, for the market leaders that are, what are the challenges associated with those that are not?
So Ed, how would you characterize the performance among insurers on the life side?
Yeah, on the life side, operating performance for 2017 was favorable. Even though the operating earnings was slightly lower in 17 compared to 16, this was due to some one-type events. One large company had some restructuring costs. Other companies that have operations in the U.S. were negatively impacted for the one-time hit for the U.S. tax reform. But overall, operating margins continue to be favorable. Underwriting performance continues to be good. We've seen companies reprice some of their DI blocks, which has helped improve underwriting performance for the year. On a premium basis, we've seen net premiums grow. The par whole life product continues to be one of the best-selling products in Canada. Also, we're seeing some companies go into PRT, pension risk transfer business, in Canada as well, which has helped grow the group annuity line of business. Other companies have initiatives for expense savings and expense efficiencies, so that's been helping maintain and improve operating margins despite the continued low interest rate environment, which has been negatively impacting investment yields. Also, a lot of companies spending a lot of time focusing on innovation. I think it's recognized that the insurance industry in Canada needs to do a little bit more catching up as far as innovation goes to keep up with other industries. I think most companies, are taking this seriously and realizing if they're not focusing on innovation, it's possible they could be left behind. And I don't think it ends, right? You don't innovate and you're done. I think it's gonna continue, and you got to keep on keeping up. So it's going to be very interesting to see what the industry looks like in the next few years after a lot of these first cuts at innovation occur.
So the new regulatory capital model was implemented on January 1st, 2018, which marks the first change in 25 years. Is AM Best expecting anything to change regarding company capital levels as a result?
Right. So the LICAT model became effective for first quarter 2018. That's a life insurance capital adequacy test. Prior to that, it was the MCCSR model was being utilized. So we saw the results for first quarter 2018, and they were favorable for most companies. Under the MCCSR, most companies targeted about a 200 ratio. And now under LICAT, from what we're hearing, about a 120 is about an equivalent to a 200. And most companies that I've seen have results above that 120 level. So I don't think capital levels are necessarily going to change for companies. I think they're going to continue to maintain prudent capital levels. And the next change coming up is IFRS 17. The final requirements for that are still being worked on, but companies still have to we're past one hurdle, the LICAT, and we got to go look forward at the next hurdle coming up, IFRS 17.
So Ed and Gordon, thank you for speaking with us today.
Thanks for having us.
Thank you.
To view a copy of the report or to learn more about the conference, visit ambest.com. For AM Best TV, I'm Meg Green.